What if every single price chart is telling a story? A detailed moment-by-moment story of the raw, emotional battle between buyers and sellers, between greed and fear. What if an ancient Japanese charting technique, developed by 18th century rice traders to dominate their markets, holds the key to reading the story and understanding the market's hidden psychology, a visual language that can show you, in a single glance, who is winning the battle for control. This is not a system for predicting the future. It is not a fundamental analysis of a company's value. It is something different. It is a tool for reading the present moment, for gauging the emotional temperature of the market, and for identifying critical turning points with astonishing clarity. For centuries, this technique was one of Japan's best-kept secrets. But in the late 1980s, one man undertook a quest to uncover this hidden knowledge and bring it to the Western world, changing the face of technical analysis forever. Welcome to Capitura. Today, we are learning the visual language of the market. We are taking an audiobook-style journey into the book that introduced Japanese candlesticks to the West and became the undisputed Bible for traders around the globe. Japanese Candlestick Charting Techniques by Steve Nison. This isn't just a summary of patterns. It's an education in market psychology, teaching you how to read the story that is hidden in plain sight on every chart. Stay with us, because after this, you will never look at a price chart the same way again. Introduction, the secret language of the market. Before we dive into the patterns, we must understand the man who brought them to us. Steve Nison was not a mystical guru or a descendant of ancient samurai traders. He was a young, curious technical analyst at a major brokerage firm in the 1980s. One day, he came across a book by a Japanese broker that was filled with these strange, beautiful charts he had never seen before. Charts made of candlesticks. He was immediately captivated. He realized that these single price bars contained far more information and told a much richer story than the simple bar charts used by Western analysts. He became obsessed. He hired translators to help him decipher Japanese texts. He built relationships with Japanese traders, slowly and painstakingly extracting the centuries-old knowledge of candlestick analysis. It was a process of discovery, of translating not just a language, but an entire philosophy of market analysis. In 1991, he synthesized all of this hard-won knowledge into his masterwork, Japanese Candlestick Charting Techniques. The book was an instant sensation. It was like a secret code had been cracked, and suddenly, traders all over the world had a powerful new set of tools for understanding market dynamics. Today, the candlestick chart is a default setting on virtually every trading platform in the world, from institutional terminals to the Robinhood app on your phone. Steve Nison is the man responsible for that. Why does this ancient technique matter so much in our modern, high-speed, algorithm-driven world? Because the one thing that has not changed is the driver of all short-term market movements: human emotion. A candlestick is a picture of that emotion. It is a visual representation of the tug-of-war between the greed of the buyers and the fear of the sellers over a specific period of time. That long, terrifying wick on a Bitcoin chart, that's the story of a panic sell-off that was aggressively bought back up. It's a picture of fear being overwhelmed by greed. That tiny, indecisive candle at the top of a massive run-up in Tesla's stock, that's a picture of a trend losing momentum, of conviction turning into uncertainty. It's a warning sign. The blind, emotional buying that drives a meme stock higher is painted in a series of long, powerful, green candles. The subsequent panic is painted in a series of long, terrifying red ones. Candlesticks provide a real-time sentiment reading, cutting through the FOMO and the hype. Even for a long-term, passive investor in the FIRE movement, understanding the basics of candlesticks can be incredibly valuable. Recognizing a powerful bullish reversal pattern at the bottom of a bear market can provide the psychological confidence to stay the course or even to add to your ETF positions. Recognizing a series of bearish patterns at the top of a speculative bubble can be a signal to be more cautious. Japanese candlestick charting techniques is not a trading system in itself. It is a set of powerful analytical tools. Steve Nison is very clear that these patterns should not be used in isolation. They are most powerful when combined with classic Western technical analysis, like support and resistance, trend lines, and moving averages. They are a tool for improving your timing, for managing your risk, and for gaining a deeper, more intuitive understanding of why the market is doing what it's doing. In the chapters that follow, we will build your knowledge from the ground up. We will start by learning how to read a single candle. Then, we will explore the most powerful and time-tested reversal and continuation patterns. We will learn not just what the patterns look like, but the crucial psychology behind them. And after each section, we will look at how these ancient signals appear on the modern charts of the assets you are watching today. This is your apprenticeship in the art of reading the market's emotions. Chapter by chapter breakdown. Part 1. The basics. Chapter 1. The foundation. Constructing the candlesticks. Before we can read the stories that candlesticks tell, we must first learn the alphabet. This first section is the absolute foundation of everything that follows. Steve Nison begins by explaining how a single candlestick is constructed and what its components represent. This is a radical departure from the simple line charts or bar charts that Western investors were used to. Imagine a single trading period. It could be a day, an hour, or even a minute. During this period, there are 4 key prices. The opening price, the highest price reached during the period, the lowest price reached during the period, the closing price. A traditional Western bar chart shows this information as a vertical line with small ticks on the left and right for the open and close. It's functional, but not very intuitive. A Japanese candlestick takes the same 4 pieces of data and presents them in a much more visual and powerful way. A candlestick consists of 2 main parts, the real body and the shadows. The real body, this is the thick, rectangular part of the candlestick. It represents the range between the opening price and the closing price. The color of the real body is crucial if the close is higher than the open. The price went up. The body is typically white or green. This is a bullish candle if the close is lower than the open. The price went down. The body is typically black or red. This is a bearish candle. The length of the real body tells you about the strength of the move. A long green body shows strong, decisive buying pressure. A long red body shows strong, decisive selling pressure. The shadows or wicks, these are the thin lines that extend above and below the real body. The upper shadow represents a range between the closing price on a bullish day or the opening price on a bearish day, and the highest price of the period. It shows how high the bulls were able to push the price before the sellers pushed it back down. The lower shadow represents a range between the opening price on a bullish day or the closing price on a bearish day, and the lowest price of the period. It shows how low the bears were able to push the price before the buyers stepped back in. This simple but brilliant design allows you to see, in a single glance, the story of the battle between the bulls and the bears for that period. A long green candle with no shadows tells you the bulls were in complete control from the open to the close. A candle with a small real body and long shadows in both directions tells you it was a period of great volatility and indecision, where neither the bulls nor the bears could gain control. Nison stresses that this is not just data, it is a visual language. Learning to read the interplay between the real body and the shadows is the first step to understanding the psychology of the market. Modern takeaway. If you open any modern charting platform today, from the professional-grade trading view to the beginner-friendly app on Robinhood or Coinbase, the default chart type is almost always candlesticks. This is Steve Nison's legacy. Learning to read a single candle is the most fundamental skill for any active market participant. Look at the chart of Tesla on a day when it has a huge run-up. You will see a long, powerful green candlestick. This is a picture of pure bullish enthusiasm. Look at the chart of Bitcoin during a flash crash. You will see a terrifyingly long red candlestick, often followed by a candle with a long lower shadow, as buyers step into lows. The candles allow you to see the character of the price action. Is the market moving in a calm, orderly fashion, with small, consistent candles? Or is it in a state of wild panic or euphoria with long, volatile candles? This chapter is your Rosetta Stone. Once you understand how to read a single candle, you can begin to understand the words, sentences, and paragraphs that make up the story of the market. Part 2, the patterns. Chapters 2 to 4, the power of one, reversal, and continuation patterns. After teaching us the alphabet, Nison now introduces us to the first words and phrases in the language of candlesticks. He shows that a single candle, depending on its shape and where it appears in a trend, can be a powerful signal in its own right. He begins with the most famous and important of the single candle patterns, the doji. A doji is a special type of candle that has a very, very small or non-existent real body. This means that the opening price and the closing price are at or very near the same level. It looks like a cross or a plus sign. A doji is a picture of pure indecision. During the period, the bulls and the bears fought each other to a complete standstill. Neither side could gain control. Nison explains that a doji is most significant when it appears after a long and sustained trend. If a stock has been in a powerful uptrend and then forms a doji, it is a warning sign. The bullish conviction is waning. The uptrend might be losing momentum. It is not a sell signal by itself, but is a signal to be cautious. Similarly, a doji at the bottom of a long downtrend can signal that the sellers are exhausted and a potential bottom is forming. He then describes several variations of the doji. The long-legged doji has very long upper and lower shadows, showing a period of even greater volatility and indecision. The dragonfly doji has a long lower shadow and no upper shadow, looking like a T. It shows that the sellers push the price way down, but the buyers storm back to close at the high. It is a more bullish type of doji. The gravestone doji is the inverse, with a long upper shadow and no lower shadow. It is a more bearish type of doji. Next, Nison introduces two other powerful single candle reversal patterns, the hammer and the hanging man. These two candles look exactly the same, but their meaning is completely different depending on where they appear. The candle itself has a long lower shadow, at least twice the length of the body, and a small real body at the top of the range. A hammer occurs at the bottom of a downtrend. It is a very bullish reversal signal. The long lower shadow tells a story. The bears were in control and pushed the price to a new low, but then the bulls staged a massive rally and brought the price all the way back up to close near the high. The bears have been hammered out. A hanging man is the exact same candle shape, but occurs at the top of an uptrend. It is a bearish reversal signal. It suggests that while the bulls were able to push the close back to the high, the appearance of significant selling pressure during the day, the long lower shadow, is a warning that the uptrend may be vulnerable. Modern takeaway: these single candle patterns are some of the most powerful and widely watched signals in modern trading. The doji and indecision. Pull up a chart of any speculative bubble that is topped out, whether it's the ARKK ETF in early 2021 or the price of Bitcoin at its all-time highs. You'll almost always find a cluster of doji candles and candles with long upper shadows at the very peak. This is the visual representation of the smart money distributing their shares to the final, euphoric buyers. It is the picture of a trend losing its energy, the hammer and bottom fishing. The hammer is the bottom fisher's best friend. Look at the chart of the S&P 500 SPY at its major lows, like the bottom of the COVID crash in March 2020 or the bear market low in October 2022. You will find powerful hammer candles on the daily and weekly charts, signaling that the panic selling has been exhausted and the buyers are stepping back in. A crypto trader looks for hammers on the Bitcoin chart to signal a potential end to a brutal correction. This chapter teaches you to pay attention to the details of each candle. A single candle could be a powerful piece of intelligence, a postcard from the front lines of the battle between bulls and bears. Chapters 5 to 7. The power of two, the engulfing and other dual line patterns. Now Nison moves on to patterns that are formed by the interaction of two consecutive candlesticks. These dual line patterns often provide a stronger and more reliable signal than a single candle alone. The most important of these is the engulfing pattern. An engulfing pattern is a powerful reversal signal that consists of two candles of opposite color. A bullish engulfing pattern occurs at the bottom of a downtrend. It consists of a small bearish red candle followed by a large bullish green candle whose real body completely engulfs the real body of the previous candle. The psychology is powerful. The first day, the bears are still in control. On the second day, the market opens lower, but then the bulls take over with such force that they not only erase the previous day's losses but close significantly higher. It is a picture of a dramatic and decisive shift in momentum from the sellers to the buyers. That a bearish engulfing pattern is the exact opposite. It occurs at the top of an uptrend and consists of a small green candle followed by a large red candle that engulfs it. It is a strong signal that the bulls have lost control and the bears have taken over. Nison provides a checklist for what makes an engulfing pattern more significant. The first candle should have a very small body. The second candle should have a very large body. And the pattern should appear after a very fast and extended move. He then discusses two other important two-line reversal patterns. The dark cloud cover is a bearish reversal pattern that occurs at the top of an uptrend. The first candle is a strong green candle. The second candle is a red candle that opens above the high of the first day, but then closes deep into the body of the first day's candle, preferably more than halfway down. It's a sign that the bull's morning enthusiasm was decisively rejected by the sellers. The piercing pattern is the bullish equivalent of the dark cloud cover. It occurs at the bottom of a downtrend and consists of a long red candle followed by a long green candle that opens below the previous low, but then closes deep into the body of the red candle. It's a sign that the panic selling has been exhausted and the buyers are stepping in with force. Modern takeaway. These two candle patterns are essential tools for any modern trader trying to identify turning points. The engulfing pattern is a climax signal. A bearish engulfing candle on a daily or weekly chart is one of the most classic signals for a speculative asset. Look at the peak of the GameStop mania in January 2021. You'll find a massive bearish engulfing candle that marked the exact top of the move. The same pattern frequently appears at the top of Bitcoin rallies, signaling the end of a bull run. Conversely, a strong bullish engulfing candle at the bottom of a brutal correction in a stock like Tesla is often the signal that the selling is over and a new leg up is about to begin. Dark cloud cover on indexes. The dark cloud cover is a common and reliable signal of a short-term top in the major market indexes like the S&P 500. A trader might see this pattern after a multi-week rally and use it as a signal to take some profits or tighten their stop losses. This chapter teaches us that the relationship between candles is just as important as the candles themselves. These two-line patterns are like short, powerful sentences in the market's language, and they are telling you that the story of the trend is about to change. Chapter 8. Stars and more three-line reversal patterns. In this section, Nison introduces some of the most reliable and famous of all candlestick patterns, the three-line star formations. These patterns are powerful because they tell a complete three-act story of a trend's reversal. The two most important star patterns are the morning star and the evening star. The morning star is a very powerful bullish reversal pattern that occurs at the bottom of a downtrend. It consists of three candles. Candle 1, a long bearish red candle, which shows that the bears are still firmly in control. Candle 2, a small bodied candle, either red or green, that gaps down from the previous candle's close. This small candle is the star. It represents a moment of pure indecision and a pause in the downtrend. The selling pressure is finally starting to dry up. Candle 3, a long bullish green candle that closes deep into the body of the first red candle. This is the confirmation. It shows that the buyers have now taken decisive control from the sellers. The three candles together tell a story. Panic selling dash, indecision dash, bullish takeover. It is a clear and powerful signal that a major bottom is likely in place. The evening star is the bearish equivalent and is a powerful topping pattern. It occurs at the top of an uptrend. Candle 1, a long bullish green candle. Candle 2, a small-bodied star that gaps up. This is the moment of indecision at the peak. Candle 3, a long bearish red candle that confirms a reversal. The story here is euphoric buying dash, indecision dash, bearish takeover. Nison also discusses variations of these patterns, such as the morning and evening doji stars, where the middle candle is a doji, making the signal even stronger, and the extremely rare but powerful abandoned baby pattern, where the star shadows do not overlap with the shadows of the first and third candles. He also introduces another three-line pattern, the three white soldiers, a bullish pattern of three long consecutive green candles, and its bearish counterpart, the three black crows. These are not so much reversal patterns, as they are patterns that confirm the beginning of a powerful new trend. Modern takeaway. The morning star and evening star are some of the most prized signals for a swing trader. The evening star at the top, The evening star pattern is a classic signature of a blow-off top in a speculative asset. A trader who saw this pattern forming on the daily chart, a hot meme stock, or a high-flying tech stock in 2021 would have had a very clear, objective signal to take profits before the crash. The psychology of the pattern perfectly captures the moment when a parabolic rally finally runs out of steam. The morning star at the bottom. The morning star is the signal that traders look for the end of a terrifying market correction. After a series of long, red panic-selling days in the S&P 500, the appearance of a morning star pattern on the chart can be the first real sign of hope, the signal that the worst is over and a new uptrend is beginning. The same applies to the notoriously volatile crypto markets. A morning star after a 50% crash in Bitcoin is a powerful signal for a long-term bull to start accumulating again. This chapter teaches you to see the market story unfolding over a period of 3 days. These patterns are not just shapes. They are short, dramatic plays that show you in real time the climactic moment when one army defeats another on the battlefield of the chart. Chapter 9. The Magic of Doji and Other Patterns. This section is a deeper look into the power of the doji and introduces several other important candlestick patterns. Nison revisits the doji, which we learned about earlier, and emphasizes its importance as a weather vane for the market. A doji is a sign of a truce, a moment of perfect balance between the forces of supply and demand. And a truce, Nison says, is always more significant after a long war. A doji after a long uptrend or a long downtrend is a signal that the dominant force is losing its power and a change in trend may be imminent. He then combines the doji with the star concept to create the doji star pattern, which we touched on in the last chapter. A doji star at the top of a rally is a particularly potent warning sign. It is the peak of indecision at the peak of the price. Next, he introduces a fascinating pattern called the harami. Harami is the old Japanese word for pregnant. This is a 2-candle pattern where a small body candle is completely contained within the real body of the previous large body candle. It looks like a pregnant woman. A harami is a reversal pattern, but it is more subtle than an engulfing pattern. It is a signal of a loss of momentum. After a long green candle in an uptrend, the appearance of a small red baby candle inside its body shows that the bullish conviction has suddenly evaporated. It is not as strong a self-signal as a bearish engulfing, but it is a warning to be cautious. The harami cross is a more powerful version of the pattern where the second small candle is a doji. This is a classic sign of a market top. He also covers a variety of other patterns, such as tweezers tops and bottoms, where 2 consecutive candles have the same high or low, signaling a strong level of resistance or support, and the 3 inside up slash down patterns, which are 3 candle confirmations of a harami. The key message of this section is that the technician must become a connoisseur of these subtle signals. Each pattern tells a slightly different story about the market psychology. The engulfing pattern is a story of a violent, dramatic reversal. The harami is a story of a trend quietly running out of steam. The doji is a story of pure, tense indecision. Modern takeaway. These more subtle patterns are essential for the nuanced, day-to-day reading of the market. The harami cross and market tops. The harami cross is a very common pattern that appears at the top of short-term rallies in individual stocks and indexes. A day trader or a swing trader might see a harami cross form on the hourly chart of a stock like Apple after a strong run and use it as a signal to take profits on their long position. Tweezers in crypto trading. Tweezer tops and bottoms are extremely useful in the fast-moving crypto markets. A trader might see a tweezer top form at a key resistance level on the Bitcoin chart, with 2 consecutive hourly candles failing at the exact same price. This is a very strong, low-risk signal to initiate a short trade, with a stop loss just above that level. The subtlety of FOMO versus exhaustion. These patterns help you differentiate between a healthy pause in a trend and a trend that is genuinely exhausted. In a strong bull market, a pullback might be a bull flag, a continuation pattern. But if that pullback forms a harami or a doji, it might be a sign that the character of the market is changing. This is how candlesticks help a trader to stay in sync with the market's short-term mood, protecting them from the FOMO that leads to buying at the top. Chapter 10 to 11. Putting it all together, candlesticks in context. In these crucial final chapters of the main section, Steve Nison brings all the pieces together. He delivers the single most important message of the entire book. You must never use candlestick patterns in isolation. A candlestick pattern is a powerful tool, but it is only a single piece of evidence. Its true power is only unlocked when it is used in conjunction with classic Western technical analysis. He calls this the principle of confluence. A buy or sell signal is much more powerful and reliable when multiple, independent technical indicators are all pointing in the same direction. He lays out a framework for combining candlesticks with the tools we know from Western charting. Trend analysis. The first and most important rule. A bullish reversal pattern, like a hammer, is much more significant if it occurs in the context of a larger, primary uptrend, i.e., it is signaling the end of a correction. A hammer that appears in the middle of a brutal bear market is more likely to be a temporary pause than a major bottom. The trend is a context for every candlestick signal. Support and resistance. A candlestick pattern becomes exponentially more powerful when it occurs at a pre-existing major support or resistance level. A bearish engulfing pattern that occurs at a random price level is interesting. A bearish engulfing pattern that occurs right at a major multi-month resistance level is a very high probability sell signal. Moving averages. A bullish candlestick pattern that forms right at a key moving average, like the 50-day or 200-day moving average, is a very strong signal. It shows that the long-term trend followers are stepping in to defend that level. Volume. A reversal pattern that is accompanied by a surge in volume is much more significant than one that occurs on low volume. High volume is a sign of conviction and institutional participation. Nison provides numerous charts to illustrate this principle of confluence. He shows how a trader can wait for a perfect storm of signals. A stock in a long-term uptrend pulls back to its 200-day moving average, which also happens to be a major horizontal support level. And at that exact spot, it forms a classic bullish engulfing pattern on high volume. This is an A-plus setup, a trade where multiple, independent forms of evidence are all screaming the same thing. This section is a powerful call for an integrated approach to technical analysis. Nison is not a candlestick purist. He is a practical technician who uses every tool at his disposal to find a high probability edge. Modern takeaway. This principle of confluence is the key to professional trading in the modern era. No serious trader relies on a single indicator. They are always looking for multiple factors to line up. A modern trader's checklist. A modern swing trader's checklist for a long trade might look like this. Is the S&P 500 in an uptrend? The overall market context. Is the stock itself in a long-term uptrend, i.e., above its 200-day moving average? Has the stock pulled back to a key support level or its 50-day moving average? Has it formed a clear bullish reversal candlestick pattern, e.g., a hammer or a bullish engulfing at that level? Was that pattern accompanied by high volume? If the answer to all 5 questions is yes, then you have a high confidence trade. Avoiding false signals in crypto. The crypto markets are notoriously filled with whipsaws and false signals. A trader who just buys every bullish engulfing pattern they see will get chopped to pieces. The trader who waits for that pattern to appear at a key support level after a successful test of the 200-day moving average is using the principle of confluence to filter out the noise and dramatically improve their odds. This is perhaps the most important practical lesson in the entire book. Candlesticks are not a magic system. They are a powerful lens that, when combined with other tools, can bring the market's intentions into much sharper focus. Modern context expansion. What would Steve Nison say today? If we could bring Steve Nison, the man who brought the art of candlesticks to the West, into the digital trading floor of the 21st century, his reaction would be one of amazement and deep satisfaction, coupled with a healthy dose of caution for the new generation of traders. The universal language. Mission accomplished. Nison's primary reaction would be a sense of mission accomplished. He would be astounded to see that his obscure passion project has become the default visual language for virtually every market participant on the planet. Ubiquity. He would open up a Robinhood app, a Coinbase chart, or a professional Bloomberg terminal and see his beloved candlesticks everywhere. The fact that a first-time meme stock trader and a seasoned hedge fund manager are both looking at the same visual data would be a testament to the power and intuitive appeal of his work. Vindication. He would see the continued appearance of classic patterns. The hammers, the dojis, the engulfing patterns, at major turning points in modern assets like Tesla and Bitcoin as the ultimate vindication. He would argue that this proves, once and for all, that these patterns are not cultural artifacts of 18th century Japan, but are timeless, universal pictures of human psychology. The rise of the machines. A new form of confirmation Nison would be fascinated by the world of algorithmic and AI-driven trading. He would not see it as a threat to his methods, but as a new and powerful form of confirmation, algorithms as pattern traders. He would rightly assume that many of these sophisticated trading algorithms are explicitly programmed to recognize and trade the very patterns he described in his book. When an AI model sees a classic morning star pattern forming at a key support level, it is likely programmed to buy. The self-fulfilling prophecy. He would argue that this makes the classic patterns even more reliable. They have become a self-fulfilling prophecy on a massive scale. If both human traders and machine learning algorithms are all watching for the same bullish engulfing pattern, the buying pressure that is unleashed when that pattern completes is likely to be even more powerful. The language is now being spoken by both man and machine. New dangers. Pattern matching without understanding, however. Nison would also be deeply concerned by the way many new traders are using his tools. The context-free trader. He would look at the culture of rapid-fire trading on social media and see a generation of traders who are pattern matching without context. They see a hammer and they blindly buy, without considering the overall trend, the support and resistance levels, or the volume. He would relentlessly preach his core message. A pattern without context is meaningless. The indicator jungle. He would be critical of the modern tendency to overload charts with dozens of complex, lagging indicators. He would see it as a distraction from the pure, immediate information of the price action itself. He would urge traders to clear their charts and learn to read the simple, powerful story of the candles first. The hype versus the chart. He would offer candlesticks as the ultimate tool for cutting through the emotional hype of meme stocks and crypto. He would say, don't listen to promises on Reddit or the hype on Twitter. Look at the chart. Is the price action confirming the story? Are you seeing a series of strong, bullish candles with high volume? Or are you seeing a series of dojis and long upper shadows, telling you that the smart money is selling into the hype? The chart, he would argue, is the ultimate lie detector. His timeless message will be adapted for the modern age. The tools for seeing the market psychology are better and more accessible than ever before. But the need for discipline, patience, and a deep understanding of context has never been greater. Closing reflection. 10 timeless signals from the candlesticks. As we conclude our deep dive into Steve Nison's masterwork, we are left with new and powerful visual language for understanding the market. Japanese candlestick charting techniques is more than an encyclopedia of patterns. It is a profound lesson in market psychology. Let's distill its wisdom into 10 timeless signals. Every candle tells a story. A single candlestick is a complete narrative of the battle between bulls and bears over a given period. Learn to read the story of the real body and the shadows. Who won the battle, and how did they win it? The trend is the context for every signal. A candlestick pattern is not a magic bullet. Its predictive value is entirely dependent on the context in which it appears. A bullish pattern in an uptrend is a confirmation. The same pattern in a downtrend is a potential reversal that needs much more proof that a doji is a weather vane. The doji represents pure indecision. When it appears after a long, sustained trend, it is a powerful warning that the trend is losing momentum and a turning point may be near. Pay attention to moments of indecision. Look for confirmation. A single candlestick is a hint, not a conclusion. A reversal pattern like a hammer or a doji is much more reliable if it is followed by a strong candle in the direction of the new, intended trend. Wait for confirmation. The shadows reveal the hidden battle. Long shadows tell a story of volatility and rejection. A long upper shadow shows that the bulls tried to rally but were decisively beaten back by the sellers. A long lower shadow shows that the bears' attack was successfully repelled by the bulls. The shadows often tell you more than the body. Understand the psychology, not just a pattern. Don't just memorize the shapes. Understand the human story behind them. The bullish engulfing pattern is a story of a dramatic and violent takeover by the buyers. The evening star is a story of a confident rally that falters and then collapses. Confluence is key. The most powerful signals occur when multiple forms of evidence line up. A candlestick pattern that forms at a major support level on a key moving average and in the direction of the primary trend is an A+ setup. Candlesticks measure short-term emotion, not long-term value. Candlesticks are a tool for gauging the market's mood and for improving your timing. They do not tell you anything about a company's fundamental worth. They are a trading tool, not a valuation tool. They are a tool for risk management. Candlestick patterns provide clear, objective levels for placing your stop losses. If you buy on a bullish engulfing pattern, your stop loss can go just below the low of that pattern. The chart is telling you exactly where your thesis is wrong. Simplicity is power. In a world of complex indicators, the simple visual language of candlesticks provide an immediate and intuitive reading of the market's health. Learn to trust the simple story of the price action above all else. How can you apply these lessons right now? The first step is simple. Go to your favorite charting platform and change the chart type from a line chart to a candlestick chart. Then, pull up a chart of your favorite stock, ETF, or cryptocurrency. You don't need to look for complex patterns yet. Just look at the individual candles. Find the last big, long green candle. What was happening that day? Now find the last big, long red candle. What did that feel like? Start to associate the visual look of the candles with the emotional story of the market. This is the first step to becoming fluent in this powerful and ancient language. It will give you a new and profound understanding of the forces that drive the market every single day.